Hello friends. Friends, we'll continue with cash flow statement. Right? And in cash flow statement, we have been discussing about cash flow from operating activities. Cash flow from operating activities. Clear? Now, in the last lecture, we discussed about the fixed asset account. Right? That in case in the balance sheet you are given the provision for depreciation account, then in that case you have to calculate depreciation from provision for depreciation account. The depreciation is debited to provision for depreciation account instead of depreciation account. Clear? Now, in this lecture, we are going to discuss something about provision for tax account. We have done this before also, provision for tax account. Right? There is a slight difference why we will prepare the provision for tax account now. Earlier what we were doing is, I just told you that for the current year provision, add back while calculating the net profits before taxes. Isn't it? I told you that current year provision for taxation is to be added to the net profits, and the last year provision is considered as tax paid. Right? So what I have told you is that current year provision is to be added to net profits, right? And previous year provision is considered to be tax paid. Clear? Right? So now, right, this is what I have told you. This remains as such. Clear? This remains as such in case you are not given anything else regarding the provision. Right? If you are not given anything else regarding the provision for taxation. Clear? Now take a very simple example. Right? You have in the morning, you have 500 in your pocket. Right? In morning you have 500 in your pocket. You added 500 during the day. Right? What is the total amount? 1000. Sorry, 1000, not 1 lakh. Clear? In the morning you have 500 rupees in your pocket. You added another 500 during the day. What is the total amount in your pocket now? 1000. But when you checked at the end of day, you have only 400 rupees in your pocket. Right? Then that means this 600 you have spent somewhere. In the morning you are having 500 rupees in your pocket. During the day you added another 500. So the total was 1000 in your pocket, but at the end of the day when you checked your pocket, you had only 400 rupees. That means you have spent 600 rupees somewhere. Clear? So same is the case with provision for taxation. Provision for tax account. Right? Now this provision for tax account will start with credit balance because it is a liability, right, by balance brought down, and we will be given the balance carried down, right? That is, balance brought down is, in the morning you have 500 rupees in your pocket and at the end of the day you have 400 in your pocket. This will be given to you. What else will be given to is that what is the amount that you added to the pocket during the day by provision for tax during current year, right? This is 500. Now this is 1000, this is 400. What is the balancing figure? You have spent 600 somewhere. This spending is what we say as to tax paid, 600. Clear? So this is 1000 and this is 1000. So this is how from provision for taxation account we can find out the figure of tax paid. This is balancing figure. If we are not given this provision for taxation during year, what we assume is that the opening balance of 500, this is paid opening balance of provision for taxation. This is tax paid during the year and the current year, and the closing balance is the provision created during the year. But if we are separately given the provision created during the year, then we will calculate the tax paid account as balancing figure from provision for taxation account. Clear, friends? Is this clear? You have 500 rupees in your pocket in the morning. You added another 500 during the day. At the end of the day, the closing balance with you is 400. That means you have spent 600 somewhere. That 600 is the tax paid. Clear? This account is prepared only if in the statement of profit and loss we are given provision for taxation. Right? Make a note here. Provision for taxation, provision for tax account is prepared if in the statement of profit and loss we are given provision created during year. Clear? Write down this note. Okay. Now, shall we do a practical problem on this? Let's see. Okay. So now let's see a practical problem on this. Say, from the following information, calculate the cash flow from operating activities. We are given the statement of profit and loss for the year ended 31st March 2016. Revenue from operations is 16 lakh. Right? Then expenses we are given purchase of stock in trade, changes in inventories of stock in trade, employees benefit expenses, depreciation and amortization and other expenses. Then we have a net profit, that is a net loss actually, of 1,65,000 less provision for taxation 50,000 and profits after tax 2,50,000. We are given the additional information that as at 31st March 2015 and 16, debtors, bills receivable, creditors, inventories, salaries outstanding, prepaid insurance and provision for taxation. Now, if you see, we are given provision for taxation in the statement of profit and loss. This provision reflects the provision that we have created during the year. What else we are given? We are also given the opening and closing balances of provision for tax. So now you can prepare provision for tax account, right? We can prepare provision for tax account and the balancing figure will be tax paid, right? So first of all, as a working note, we will prepare provision for tax account. Clear? Now, by balance brought down, we are given the balances. The balance as at 31st March 2015 is 15,000. So that is our opening balance. Closing balance is 10,000. Provision created during the year is 50,000. Right? So I can take here 15,000. We have the closing balance to balance carried down, that is 10,000. And what is the provision created during the year? By provision created during year was 50,000. Now what is the balancing figure? You have 50,000 in your pocket. You added another 50,000. In the morning you have 15,000 in your pocket. You added another 50,000 in your pocket, but at the end of the day you have only 10,000. That means the remaining amount is to bank, in bracket we will say tax paid, right? This is 55,000. This is the balancing figure. Clear? So this comes to 65,000 and 65,000. So now you can do the question in a normal way. We'll say cash flow from operating activities, right? Cash flow from, so the first step is net profit before taxes. So we have this net profit before taxation, that is a loss of 1,65,000. So I'll say net loss before taxes and extraordinary item. No extraordinary item here. Clear? This is 1,65,000. Clear? Right? Now we have to adjust non-cash and non-operating items. Clear? Now, what are the non-cash and non-operating items here? Purchases of stock in trade? No, nothing related to the non-cash or non-operations. Changes in inventories of stock in trade, that we will do in current assets. Working capital changes. Employees benefit expenses, no treatment, right? Because they have been subtracted correctly. Depreciation and amortization, 1 lakh. This is a non-cash expense. So we will add back depreciation and amortization, right? This is 1 lakh. Anything else? Other expenses? No, because other expenses we will assume that these are cash expenses, right? That is, they involve the cash inflow and outflow, and these are related to the routine operations of the business, so nothing to do with them. Additional information: debtors, bills receivable, creditors, inventories, salaries outstanding, prepaid insurance, all related to the working capital changes. So that's all for this. So this is what we get as 65,000. I will say operating loss before working capital changes, right? Now we have to adjust working capital changes. Clear? So now we have to adjust working capital changes. I'll say what is to be added and what is to be subtracted. Clear? Let's see. Debtors, because upper information here we have just the inventories of stock in trade that is to be dealt in the current assets, right? We have that information here also, so nothing to worry about this. We have all the information in additional information only, right? Now the debtors have increased from 1,25,000 to 1,50,000. Our current asset has increased by 25,000, right? We will add back or subtract. We will add or subtract. Current assets move in which direction? Sundry debtors have increased by 25,000 and the current assets move in opposite direction. So I will say we have sundry debtors of 25,000 will be subtracted. Clear? Next, bills receivable. It is again our current asset, but this current asset has decreased from 40,000 to 30,000. If a current asset is decreasing, we will add this back because the current assets move in opposite direction. Clear? Next is creditors, right? Creditors have decreased from 85,000 to 75,000. Our current liability has reduced by 10,000. The current liabilities move in same direction. So sundry creditors by 10,000. Clear? Next is inventories. Our inventory has increased from 1,10,000 to 1,35,000. There is an increase of 25,000 in the current assets. This is what is given here. Changes in inventories, 25,000. Right? Clear? But here our inventory has increased by 25,000. Right? So what we will say is, if there is an increase in the value of a current asset, then what to do? If there is an increase in the value of a current asset and the current assets are moving in the opposite direction, we will subtract inventories here 25,000. Clear? Then salaries outstanding. It is a current liability. Our current liability has increased from 10,000 to 15,000. If there is an increase in the current liability, that means we will add back because the current liabilities move in same direction. Clear? 5,000. Next, prepaid insurance. It is a current asset. Our current asset has increased from 25,000 to 27,500. There is an increase of 2,500. So we will subtract, because our current asset is increasing and increase in current asset is subtracted, current assets move in opposite direction. Clear? Anything else? Provision for taxation that we have already dealt with, right? This is what we say cash generated from operations. This comes to negative 1,12,500, right? Then we will say income tax paid. This income tax paid we have calculated from the provision for taxation account, right? We have calculated here the tax paid amount, that is 55,000. Clear? So this is what we get as cash flow, because we don't have any extraordinary items. So this is cash flow from operating activities. Clear? This comes to 1,67,500 negative. Clear? So this is the role of provision for taxation account, that if you are given the provision created during the year in statement of profit and loss, then that means you have to prepare provision for tax account, and from that account the balancing figure we will obtain as tax paid. Clear? The balancing figure reflects the tax paid during the year, and that tax paid we will use in cash flow from operating activities. Clear, friends? So this is how you prepare cash flow from operating activities. With this we complete cash flow from operating activities. We have covered all the topics related to cash flow from operating activities. Clear? So if you have any queries, you can send me an email at ksjteaching@gmail.com. Clear? So in the next lecture, what we are going to do is, in the next lecture, we'll start with cash flow from investing activities. Right? We'll start with cash flow from investing activities. This is comparatively simpler. The next two activities are comparatively simpler now. The bigger one was cash flow from operating activities. The next two are comparatively simple now. Right? Clear, friends? So this is what we are going to do in the next lecture. So that's all for this lecture, friends. Thank you so much.